Welcome to our investment webinar for our Core Plus asset investment in Portland, Oregon and Vancouver, Washington. My name is Ryan Gibson with Spartan, and I'll be taking us through the presentation tonight. But before we get started, if you have any questions whatsoever throughout the course of the webinar, you can always reach me at ryan@spartan-investors.com. You can always put a question in the chat window. If we don't get to your question, you can always email us at the end. And also, for all deal documents, you can visit our investor dashboard by going to Spartan-investors.com. You can log in, and you can see here I've got the screen presenting where all the deal docs are. The underwriting, the projections, the offering memorandum, the subscription agreement, funding instructions, etc. And then you can see that Start Investment button there that provides a link to start your investment, sign the documents, and subscribe to the deal. But tonight we're talking about three of the nicest assets that we'll have in our portfolio or that we've ever purchased in some of the best locations we've ever operated in. And we're going to be talking about the markets of Portland, Oregon and Vancouver, Washington. And so before we get started, I'm going to talk about our disclaimers, which we're not offering any tax, legal, or investment advice. Do your own due diligence, consult your legal and tax team, and this is just a general overview of the investment. This investment opportunity tonight is open to accredited investors only, and the minimum investment is $100,000. So for those that are just joining, I see that there's some new names and faces on the webinar tonight. Just a little bit of background about Spartan Investment Group. My name is Ryan Gibson, and I serve as the CIO and co-founder of the company. Joined with me in this picture is Scott Lewis, our CEO, and also my business partner and co-founder. We started Spartan Investment Group to build out a great organization where we operate, build, and buy self-storage properties. And this is our leadership team. We're headquartered in Golden, Colorado, with a satellite office here in Seattle, Washington, where I am this evening. And our leadership team consists of seasoned storage professionals coming from Extra Space and other REITs that are well-versed in operations, construction, and asset management. We're 150 full-time employees strong. We have a deep bench of storage professionals with over hundreds of years of experience. We're vertically integrated, and we handle all aspects of the operation from finding, building, buying, operating, and selling the asset. Over the past decade, we've really grown. We've aggregated a 57 property portfolio across 12 states. We've sold some properties as well that are not included on this map. We've built up a portfolio consisting of over 4 million square feet of storage, or about 30,000 units. And our focus has really been on growing markets to include the Pacific Northwest to the Sun Belt, where the job and population growth is going and where there's strong favorable demographics, specifically good market rents for self-storage. Now, we've had a tremendous amount of success in our realized investments, or our track record. We've had actually 16 full-cycle investments dating back to 2014, with our worst performing deal realizing a 12.1% IRR, and the most recent storage exit achieving as high as 83.32%. We've never lost investor capital or had a capital call. But let's get back to kind of the history of why we got into this investment space in self-storage in the first place. Scott and I, when we led Spartan to choose a new asset class back in 2015, 2016, we basically came up with three decision-making criteria. We wanted something that was easy to maintain, easy to evict, and easy to operate. And self-storage really percolated to the top. It's a great asset class, especially since it's been recession-resistant for the last 40 years. You can see here that even the Black Monday, the dot-com bubble burst, the Great Recession, and the most recent COVID-19 pandemic, self-storage occupancy has continued to grow and stay recession-resistant because of the reasons why people use self-storage, which is the 4Ds. And the 4Ds are really what drive self-storage utilization: death, divorce, displacement, and downsizing. So when somebody has a family member die or pass away, or they're growing family, they're going to use self-storage. Divorce, people who move or get displaced for job relocation or buying a new house, or moves, and downsizing. So these are really why people use self-storage. About 70% of our customers come from this. And it's been one of the best performing asset classes over the years because it depends on these four life events. It benefits from them. I always tell the story about how I used self-storage for the first time when I moved houses when my family was growing. I had a life event and I sold my house in Seattle and bought another one across town. And it was because we were growing our family and we had to get more space. So basically, to sum up, over 70% of our customers are going through some type of life event and they need extra space to do that. The other 30% of our customers are business use. And these are folks that own Amazon, Etsy businesses, sheet metal contractors, landscaping companies, real estate furniture staging companies, vending or food distributors. equipment storage, and many, many other reasons that people might use some extra space to use a self-storage. And one of the trends that we noticed was that self-storage demand is on the rise. So people might say, hey, these things are getting kind of built everywhere. What's the deal? Well, if you look at this chart, dating back to the 90s, you can see that what the utilization per square foot was per capita. And you can see back in the 90s that people used about 2 square feet of storage, and that's really grown to well over 6 square feet per person. And so this is becoming a tool that people use to transact in their life, especially as the cost of housing has gone up. So if you actually overlaid a bar line here and you saw the rising cost of housing, it would probably directly correlate with the direct utilization of self-storage, because people are living in smaller places and real estate's more expensive, and storage serves as a great place to store that extra stuff. This is kind of the outlook for demand, why people use self-storage. And you can see all the way over to the right, bottom line is no room. And that's why I like the Pacific Northwest deal so much that we're talking about tonight, because Portland is an expensive housing market, and it's creating a perfect storm for demand of storage. The urban growth boundary has kept the urban and suburban landscape attractive and livable, but a steady stream of migrants to the area from other parts of the country have really pushed up the cost of housing significantly. So when you think of creating extra space for those things that you need, the recreational activities, the moves, the things that you need to move out of your apartment building to make room for an office, or having more space, or having more relatives live with you, it's really become quite a demand. The other things here, student demand, not needing something that you're using, remodeling, moving, etc., are all drivers of storage. And I love the moving one, because we'll talk tonight about how much growth is happening within 3 miles of each of our facilities that we're going to talk about. So the exit strategy for Spartan. So generally what we buy is mom and pop properties. So you can see Spartan in the middle. We're kind of a medium-sized fish, and we go and aggregate lots of properties from mom and pop owners. So these are 70% of the facilities you see in the country are owned by mom and pops. We come along, we aggregate all these properties, make them into a portfolio, and either sell them off one by one, or we reposition them to the bigger fishes, which is over to the right, which are the private and publicly institutional groups that might be REITs, like Public Storage, Extra Space, and so on. And so the Portland opportunity was really unique for us because it provides an anchor of 3 premium assets in a market where we already have properties, and it makes us our portfolio highly desirable for an exit. And so when you look at where we are today, these are our existing properties. We have a property in Black Diamond just outside of Seattle that we built. We also have a property just outside of Portland that we're operating in Sandy, Oregon. And we're also adding a site in Oak Harbor, a Class A facility, and Bellingham, Washington, we're under contract. So by adding the PNW trio, the 3-pack here, we're going to have a strong institutional quality portfolio right here in the Pacific Northwest, making our exit strategy really solid as these desirable assets are located in the Pacific Northwest and co-located. I think specifically we're going to have over $100 million of a portfolio that's all Class A new product within the last decade of being built. But let's get down to Portland. So you probably watch the news and you probably like what you hear or don't like what you hear about Portland. But here's the reality. People are moving to Portland en masse. Millennials live in Portland. Jobs are in Portland. Portland is a beautiful Pacific Northwest city. And at the end of the day, blue or red, we can thrive in this market for several reasons. Number one, Intel, Nike, Columbia Sportswear anchor a lot of the employment here. And Portland's economy is really diversified. It includes high-tech and creative employment. It also has earned the nickname the Silicon Forest. And while there's significant blue-collar employment here too, in forest product and mills and transportation, the workforce is really slanted towards executive and professional positions. And the market's really strong. And the other thing that's really noteworthy is that the average age in Portland is 38.3 years old. That's a millennial. That's somebody that's going through a lot of life events. Somebody's going to have a demand for self-storage. Specifically, when you look at self-storage as an entire industry, our number one customer is a millennial. The most customers in our portfolio stem from the millennial generation and Gen X. So when you think about the average age in Portland being 38.3 years old, you're going to see that that is a prime hunting ground for storage customers. These are all the people that are buying their first houses, moving to an area, and needing storage because life is happening. And so when you peel back the layers of the economy in Portland, you're going to see an average household income across the three properties within a 3-mile radius of $124,000. You can see the Holiday locations got 119, Belmont 133, Vancouver 120. These are solid markets with great population growth. If you look at the Vancouver property specifically, 0.88%, that's more than double the national population growth. So when you think about, hey, like why would anybody want to invest in Portland? Tenant landlord laws are a problem, but not for storage. And I'm going to cover that here in just a moment. But some other Portland accolades. It's ranked number 1, University of Portland in the Western region out of all the other universities. It's ranked number 2 as the fiscally fit cities. It's ranked number 18 for best cities for young professionals. And lastly, ranked 22 for best places to live in the United States. Portland has really proven itself out. But here's the thing that I really like about Portland, and specifically this area that borders Washington and Oregon. The reason why a lot of population drives down here and lives here is because of the tax benefits. You can live in Washington and pay no income tax and drive just a stone throw across the Columbia and pay no sales tax. So the population growth on this border between Washington and Oregon is really growing, and a lot of houses are being built in this market, and specifically the Vancouver Camas market and in the Portland market, which we'll address here in just a second. And here's the thing. Even though we're in a blue state, we have friendly tenant landlord laws. So for example, this is right from our lease in Washington and Oregon. We may sell or dispose of goods that tenants put here if we haven't received payment for a continuous 30 days. So we will lock out the tenant if they don't pay after 3 days, and then we put them in the auction process and sell their belongings and get our unit back if they haven't paid for 30 days. There is no tenant landlord law like you have in multifamily or single family rentals. We don't deal with that in self-storage, which is amazing. So we can be in this primed, growing, beautiful market and not be subject to a lot of the blue state laws that you typically come across, which would otherwise turn away people from investing in that market. Portland is about 50 miles from Mount Hood, which is a beautiful skiing, recreation, hiking, outdoors area. This is where I actually go personally on vacation sometimes. And it makes it a great place for young professionals looking to have the best of both worlds. Great high-tech employment and the outdoors. On the flip side, we're looking at, from the Portland side and looking over to the Vancouver side, you can see that this market is really attracting a lot of young families. People have a good time. They live in Portland, and they settle down and get a family, and they move to Camas and Vancouver, and where the housing stock is abundant, and they can buy affordable housing and live there. And guess what? We benefit from both. We benefit from the millennials in Portland. We benefit from those that decide to move out to the other side of the river in Vancouver, Washington, and benefit from the good housing market that's out there and the great schools and the great areas to live. We have properties on both sides. So it's no wonder why there's been a huge population density that's already accumulated and developed demand for self-storage around these sites. Specifically, we're going to talk about the Holiday location. So there's 3 locations you're going to hear tonight: the Holiday, the Belmont, and the Vancouver site. So let's just talk about the Holiday location here in Portland. There's 222,581 people that live within 3 miles of the site. That's a very dense site, a population. It has the best occupancy in the portfolio, and it has an impressive unmet demand of storage of over 300,000 square feet. And we don't have any competition coming in around that site. It's incredibly difficult to permit and build in Portland. There are no planned developments around our sites for storage. So that means that not only are we well occupied, over 90% occupied in this property, and there's another 300,000 square feet of demand, but there's no competitors coming into the pipeline, and there's also a significant amount of population growth. Let's talk about the Belmont site. So the Belmont site has about 230,123 people around it. This also has no competition in the pipeline. And when I visited this site personally, I love the fact that it was brand new Class A multifamily buildings, industrial and businesses that just engulfed this location. And we'll show you pictures of that in a second. And then lastly, just across the border, we have 77,000 people that live around the Vancouver location. And it's basically, this site is nestled in a desirable neighborhood that boasts a big population within 3 miles. And it's maintained this really strong occupancy, likely due to the 4,525 residential units that are being built within 3 miles of the site. So when it comes to having a built-in customer base, it doesn't get much better than this. Now let's talk about growth. So what's coming? Why do you invest and believe the business plan with population growth, right? So there's more than 25,000 residential units coming in within 3 miles of our property. And here's where they all are. Some units have already been delivered. So about 1,790 units have already been built and are up for sale or have sold. And then there's over 17,000 multifamily units planned and over 7,000 townhouses planned. So when you think about no competition in the pipeline and a ton of population growth, the market fundamentals are some of the best we've seen. Now let's talk about location. So in real estate, I think about the three things: market, location, and asset quality. Those are the three things that I look at. So the market is excellent, but the locations speak for themselves. We have this facility, the Holiday location specifically, that's got over 150,000 vehicles that drive by it every single day. And I gave that little speedometer there to kind of give you a sense of what's good. So an excellent. So we like to see at least 25,000 cars to be excellent, from customers benefiting from driving by and seeing your property and then wanting to move in. But this site has over 150,000 and it's right by our property. And also that 156,000 doesn't include the cross street that runs above the freeway as well. So this site is the best occupied. It has a ton of population around it, and it benefits from this great visibility. And the other locations benefit as well. Now let's talk about built-in equity. Making money when you buy in real estate is the best way to buy real estate. And so we had the unique opportunity to buy an asset that was in a core fund that was sold because of the out-of-balance office and other assets that were in the fund. And we're getting an excellent going-in cap rate of 6.6%. A couple of years ago, there's no way this thing would have traded for more than a 5% cap rate. So when you look at the average cap rate data from Green Street at 5.3% for private sales, we're getting baked in value day one, meaning that its acquisition price, it reflects our commitment to capitalizing on market inefficiencies and providing investors with the value on the day that they buy the asset. And so you can see the substantial difference between our going in cap rate and where the market's trading at today. Jumping to asset quality, when I drove by the Belmont site specifically, this site is just one of the best, and they all come with really great offices, and they have the Extra Space branding, which is the largest operator in the world for self-storage and one of the best property management firms that you can hire. So when you look at the different locations, we're going to walk through them one by one. You're going to just see the asset quality shine through on every single one of these assets. These were all built in either 2017, the Holiday site, and then 2018, Vancouver site was built, and then also the Belmont site was built in 2018. So these are brand new. These were sites that were built by an excellent contractor, well known in the Pacific Northwest, and then they're fully stabilized. So they've already been leased up and gone through a lot of the risk. And our investors get the benefit from the rewards of having all the storage amenities and modern amenities that somebody would come to expect, especially in apartment living on these properties. And we also have indoor units and outdoor units, which I'll go through now. So this is just some of the details surrounding the Vancouver site. It's 90% physically occupied. It's got about 74,000 net rental, about 700 units, 41,000 cars drive by the site a day. And then we have a huge housing accounted for within the 5 miles. Specifically, there's over 8,400 residential units coming in within the 5 miles. So this site is just absolutely booming. I don't know if people are familiar with the Vancouver Camas area, but it is a growing market. The other thing that we like to joke around about, if you can smell a McDonald's and see a Walmart, it's usually pretty good for self-storage. And you can see that you can just about smell the McDonald's here from a distance. But you can see that this property is literally just baked right into rooftops. Rooftops where we're going to get our storage customers. Rooftops that have smaller single-family dwelling units or townhouses that need this self-storage demand. And as it rests right on 164th Avenue, this is going to benefit from 41,000 cars that drive by every single day and know the site, which is why it's been so well occupied in the market. Let's talk about the modern amenities of Vancouver's property. So it has a fully automated gate. It has a drive-up. You can see where it says modern amenities, a drive-up sliding glass door so you can unload your belongings or pack up in without being in the rain, which it tends to do here. And then you also have these unique drive-up units that people really benefit from because you can pull up, off-load your stuff, and be on your way. You don't have to go into a building. Now, if you want to go into the building, you have the heated units indoor to keep your units more protected. If you have a humidity or moisture control concern, you can have that as well. So this facility literally checks every box you can check. It's recently constructed. It's fully stabilized. and provides the best amenities among its competitors in the market. Going to the Belmont site, this is an excellent location and it's just a gorgeous building. Multi-story, it's on a main road, has a great office, and it has easy access. So if you're in that urban dwelling and you want to drive through your property and easily unload and load your belongings, have quick access to an elevator, this is it. It doesn't really get much better than this. This property is over 85% occupied and has about 61,000 net rentable, about just shy of 700 units. And the housing count within 5 miles is incredible at over 230,000. And again, within 5 miles, there's over 35,000 residential units planned. This one was built in 2018. Now, this benefits from 13,000 cars a day. Now, it's a little bit lower, but this is also anchored right in the middle of an urban setting. So really nice asset, very well located. It's like right in the town center. So everybody sees this when they come into the town. And you can see here, there's a lot of really great amenities around it. Good location. It's on Main and Main. Beautiful Class A glass multi-story building. But why I love this building so much is because I know how much it rains here and how much it stinks to offload and load in the rain. But if you look down here in the bottom left picture, you'll see that entrance. And I put an arrow on it. And you can see actually where you can drive into the entrance, be inside the property with your vehicle, offload your belongings into an elevator, and then exit the other side. So if you can imagine being in the city, this is a huge convenience because you can not only get out of the elements when you're bringing your belongings in, but you also have the ability to just easily drive in and drive out, which is great when you're trying to park in like a downtown urban area. It also adds another layer of security and protection for those that are wondering, hey, where should I store my stuff? People look for well-lit, well-secured, well-run properties, and this one really checks that box with having this modern amenity of being able to pull out of the street and load and unload your belongings in a protected area. Really beneficial. So lastly, we're going to talk about the Holiday location. This, again, is the best occupied property, multi-story, tons of drive-by traffic, beautiful office, indoor units, and it also has a lot of the same modern amenities that we talked about. So really well occupied, just shy of 90% the last reading we took. 88,000 net rentable. It's a little bit bigger of a property, about 1,000 units. And the future demand is really strong with over 30,000 new homes coming in within 5 miles and just a great vehicles per day reading on the property. Specifically, when you look at 60th Avenue and Interstate 84, it's 156,000 cars that drive by a day. So this is why it's been so well occupied. You can see the 5819 Gleason. That's a really nice new multifamily development that came in. We have industrial, we have rooftops, tons of traffic that's going to the site. And you can see some of the modern amenities. Again, you can offload and unload out of the elements in a well-secured area underneath a covering, gated access, elevators, etc. So really just well-run property. All right, so let's get down to the numbers. What does this mean to the investor? So we're targeting 3 to 7.4% cash flow, depending on investment amount. We do monthly distributions. Our distributions on a new asset, acquiring this new asset like this, we intend to close late April, early May, and then our distributions start about 90 days after closing. So you can expect that in the August-September timeframe. And these returns are also outlined in the OM, the offering memorandum. You can see this is projecting a really great 18.5% annualized return based on market rent growth that we projected and the exit cap rate. And we've also put together an equity multiples. It's just shy of doubling your money in 5 years. It's a 5-year projected hold and $100,000 minimum if you just joined us. Now, we have put together very favorable investor splits based on your investment amount. So everybody gets money distributed pari passu. Based on your investment amount, your split's just a little bit better. So we're giving an 80-20 split to investors. And then after we hit a certain hurdle, it goes to 70-30. And after you've made your money, then it goes to a 50-50 split. And of course, we always have a preferred return on our deals, 6, 7, or 8%, depending on investment amount. You can review the investor splits in the offering memorandum as well. So let's talk about the capital stack. How much money are we putting down? What kind of debt are we getting on the asset? Fixed rate interest is a hot topic right now, and we absolutely are locking in fixed rate. We're not doing any floating rate, and we have a fixed rate lender on the line who's an insurance company who loves these assets. We had some of the best debt providers bidding on these properties. Goldman Sachs, Barclays, Principal, the top shelf lenders have all bid on this asset. We've gone with a life insurance company that's been very bullish on this asset. Good markets, high quality assets, great operator, etc. So we ended up with great terms, 5-year loan with interest only throughout the entire course of the loan. And while we underwrote and projected your returns based on a 6.42% interest rate, we actually ended up with a 6.38% interest rate. So the numbers just got a little bit better. We plan to put down a 43% down payment and then leverage 57%. So it's fairly low leverage and very favorable terms, the life insurance company that we're moving forward with on the debt. Debt terms are pretty flexible considering it's a life insurance company. For example, they provided us a degree of flexibility in chopping up the assets if we wanted to sell one individually or sell them as a group sale. Got some great things negotiated in the contract. So really healthy capital stack. Here's all the numbers. And again, this is all in the investor dashboard. We're raising about $21.6 million. We're taking out a loan about $25 million for the asset. And that totally stacks to a $47 million total project cost. We've got some closing costs. We've budgeted about $500,000 in repairs. Although the assets have little to no deferred maintenance, we're still planning on making some improvements to the properties. We can touch them up a little bit. And then we have some working capital and some other fees associated with doing the deal. So those are our sources and uses. And this is our break even. So we have a really low break even occupancy in this investment. So specifically in the first year, we're looking at about a 66.4% break even occupancy, and it lowers as we complete our business plan, as new residents move to the market, as we start to push rents, move our rents from mark to market, and continuing to deploy our growth strategy. So you can see ending the investment with a great low occupancy break-even point of about 60%. So very good, very healthy on that side of things. So let's talk about next steps. So you can always email me at ryan@spartan-investors.com if you get lost in the process. But this is our website, spartan-investors.com. And you can always find our investor portal on the top right-hand side of the website. When you click on that, it's going to send you this page. If you haven't created an account, you can create one very easily on the bottom there. You just click Create Account. If you've logged in or if you've gotten invited to create a password and log in, you can use that email link that we send and then just type in your email address. When you get into the portal, you'll see the PNW trio. That's the investment we talked about tonight. When you click on that, that'll bring you into the deal room. And that Start Investment button is the way that you go in and actually start filling out some legal paperwork. And like I said, you can review any of those offering documents before you sign anything. The subscription agreement is what you're signing when you click on Start Investment. So if you wanted to read that before you signed it, it's right down there on the bottom right-hand side. So we're going to open it up for questions tonight. QR code on the screen here will actually bring you right to our investor dashboard, or you can just email me and I can send you a link. But we're buying 3 institutional quality assets, Holiday, Belmont, and the Vancouver site. And they've got excellent market fundamentals, population growth of over 25,000 houses coming in within 3 miles of each site, and excellent market fundamentals in Portland with major employers and millennials making a perfect storm of customer demand. We've got over 300,000 square feet of unmet demand in some sites, and we have nobody in the pipeline. So we really view this as a good core plus investment opportunity in a high quality market. The locations are excellent with high visibility from the main road and very attractive looking buildings. We're buying these at a great price, and we're offering favorable investor returns to make sure that investors get that favorable 80-20 split before we start taking any significant upside in the deal. 80-20, then it goes to another hurdle to 70-30 to make sure that you're getting paid first. And then our minimums are $100,000. And this investment is open to accredited investors only. So with that, I've got a couple of questions that I just wanted to address. I see in the chat window. Number one, will there be bonus depreciation? And there absolutely will. And how will the new regulation impact that? I'll do my best, but that's sort of a guess at this point. But yes, we do a cost segregation study on all these assets, and we will have bonus depreciation and cost segregation, and investors will benefit from having that tax loss. I've seen anywhere between 15% to 40% of your investment amount. It just really depends. The rules are being contemplated to go back to 100% bonus depreciation for those that know about that. And there's a rumor that if it gets signed in, anything bought in 2024 potentially would qualify for 100% bonus depreciation. But look, I'm not the expert and I don't work in Congress, so it's just friendly conversation at this point. Yeah, good question on if you have a self-directed IRA, we do offer investments. 5 or 10% of our investors use a self-directed retirement account to invest. So the question is who's going to manage these properties and these assets? This is the best of both worlds. And I love this question because the properties are already branded Extra Space. They're already managed by Extra Space. Extra Space is a publicly traded REIT. So we're actually kind of partnering with the REIT here, and they're going to continue to run these assets in the way that they have for a long time. And there's a benefit to that because when you take over a property and change ownership, you usually have some friction. People see the new sign under new management, et cetera. There's going to be no friction when we take these assets over from Extra Space. And Extra Space, we've negotiated great terms with them to property manage our assets. And they're the number one operator. They have market presence. They have market dominance in Portland. So we see a really great opportunity to have an operator like Spartan that has its own asset management, its own property management, and its own storage professionals able to sort of look over the shoulder of a really well-run operator, making this an awesome opportunity in a place that we have assets already and boots on the ground. Great question. The projected hold period, good question, is 5 years. And the exit strategy, we went through the exit strategy in the previous slide, but we built this portfolio here in the Pacific Northwest of Class A assets, and we're only continuing to add with one in Bellingham, one in Oak Harbor, these 3 down in Portland and Vancouver. And that's going to help us create a market presence and become attractive acquisition target for somebody or sell them off individually. And what's unique, though, is that everything that we own here in the PNW is going to be Class A institutional grade properties. So that's all the time I have for questions this evening. But if you have a question, again, you can just email me. If you didn't get a chance for me to answer it, you can just email me at ryan@spartan-investors.com. We can get that posted. Appreciate everybody coming out and considering this investment in the PNW. The next step is to invest. Funding is now open. Thanks, everybody, and have a great night.